heard me say this before, but bear markets are the time for building. And it's through investing in bear markets, specifically crypto bear markets, where you can get 50, 100x, or even 300x or more return. I have an update on some key upgrades from a project with more than 100x potential that we've covered on this channel numerous times, and that project is Radiant Capital. Now, before we get into this video, I do have to give the disclaimer that this is not financial advice. Please consult with your financial advisor before making any investment decisions. This video is for your education purposes only, and as always, please do your own research. So in this video, we're going to be covering this new Radiant Capital upgrade and why it's so important. We're going to talk about how Radiant plays into what I think is going to be the next narrative that could kick off the next major bull rally. And at the end, we're going to go over price prediction. So without further ado, let's get into the content. So like I said, I have about 3 videos covering Radiant specifically, as well as other videos showing how I'm using Radiant to short crypto and get paid passive income to do so. Those links will be in the description, but just to give a brief overview of what Radiant is, they are a decentralized money market. Just like Aave and Compound, you can deposit assets and use them as collateral to take out loans, etc., etc. So it's borrowing and lending essentially. But the difference is Radiant Capital offers omni-chain borrowing and lending, which means you can deposit on, let's say, Ethereum, and you can go borrow on Polygon to go yield farm on Polygon, or deposit on Arbitrum and borrow on Optimism. Or let's say, you have your loan pending on Optimism, you can pay it back on Binance Smart Chain, etc., etc. And while this does sound really dry, this is actually solving a huge problem. There isn't a lot of interoperability. And like I've said in other videos, before DeFi and crypto takes over the world, these protocols need to be able to talk to each other first. They need to be interoperable. Web 2 had to go through the same upgrades. It's like, if you study Web 2 and how it evolved, you'll see the same processes here. So it's like, for example, emails. Imagine, like in the beginning, different emails couldn't talk to each other. So imagine if you wanted to send me an email. I have a Gmail and you have a Yahoo, but you can't send me an email. Like, imagine how that affects your email campaigns. If you want to send out mass emails, like all that stuff comes into play. So interoperability had to happen. So now I can email anyone from any email and not have to worry about if they got it or not, whether if it's Gmail, Hotmail, AOL, Yahoo, etc., etc. Okay, so let me go over a few things that I really like about Radiant Capital that I covered in other videos. I like how the incentives are aligned with this project. So the founders have permanently locked 25 million Radiant tokens. Right now, Radiant tokens are 10 cents. So that's $2.5 million that they have locked permanently. Now, that's how their salary gets paid. By you having your tokens locked, you make money from the Radiant platform, a real yield, which brings me to my next topic that we're going to get into right now. But the team has every incentive to make this protocol the best that it can be, because if they can't make it good enough for people to stake their Radiant tokens so that they can make money and so that people can take out loans, etc., etc., the team doesn't make any money. So my mentor always told me, people are motivated by their own selfish desires. And when you're working with someone, you keep that in mind, and you just want to make sure that everyone's selfish desires aligned. And that's what's happening with this project. The incentives of the user and the incentives of the project founders are in alignment, and that is a recipe, not a guarantee, but a recipe for a successful project. Now, we were just talking about real yield. Now, I think real yield is going to be the narrative that sets off the next bull market. Every bull market, if you look at it, had a narrative. You either have the Bitcoin halving, you had DeFi summer 2020, you had NFTs in 2021, you had layer 2s. The list goes on and on. I think real yield protocols, and when I say real yield, I mean protocols that share revenue with the users. And I'm not talking about token inflation. Like, if you look across all of these dApps, most of the yield farming profits were subsidized by token inflation, meaning comps started this whole thing off. They said, hey, come and deposit funds on here that we can use as collateral, and then we'll pay you not only in that token that you deposit, but we'll also pay you in comp tokens. Compound controls those tokens. They were giving them out, people were selling them, and then they were doing that. Everyone else started doing this, and people were, you have these mercenary farmers hopping from platform to platform, just farming the token and selling it, right? Through staking the Radiant token on the Radiant platform, they actually share their revenue with you that they get from borrowing and lending fees, right? So if you look at Compound and Aave, they take all the fees and they give it to the team and the developers. All of the fees from Radiant actually go to the token holders, which is a higher incentive for people to actually hold the tokens. And not only are they paying you in Radiant tokens, you're getting paid in Bitcoin, Ethereum, USDC, DAI, and Tether. like actual assets that I don't mind holding for a long time. And the Radiant team is entirely bootstrapped. They don't have any VCs. They didn't raise a seed round. This was all self-funded, which is another thing that I really like. Now, one drawback that I feel a little iffy about in Radiant is the founders are anonymous. I have no idea who they are. But if you go into their Discord and just follow their Twitter and their community, the Discord moderators and the team are actually really active, and it's not hard to talk to someone, ask questions, give feedback, and actually get more information. So they're really active in the community, so it helps. So now that we've finished with the brief overview, let's dive into their Medium article and go over these upgrades and how I think they can just change the game in DeFi. So here we are at the Radiant Capital Medium article, and we're just gonna go over the most important parts, and I'm just gonna make this as simple as I can. Announcing Radiant version 2, a new era in DeFi. And they go to talk about most crypto projects do not run profitable organizations. 98% of all projects in crypto are not even mentioned in profit conversations because they simply have no revenue. In DeFi's new emerging narrative of sustainable real yields, we just talked about that, a lack of revenue is simply not acceptable. The goal is for Radiant version 2 to be named the protocol with the lowest price to fee ratio in all of crypto, while it's continuing to offer seamless omni-chain lending. Check out this chart here. It tracks the price to fees ratio of all DeFi projects, similar to PE ratios for stocks, and a low ratio is indicative of a token with high fees and low market cap. So if you see here, Radiant Capital is the first one on the list, and the last one is Uniswap, and they're up there with QuickSwap, Lyra, Convex, Lido, SpookySwap, GMX. GMX is another real yield protocol that I really like, and I think they're going to be a part of the next narrative as well. And I think it's going to inspire other projects to follow suit because they know that people are going to want to be involved in projects to give out real yields that are sustainable, where the token isn't just going to be dumped, you know? So let's read on. There are thousands of projects that will never make this list because they not only have zero fee capture, but they distribute their tokens at 20x or 100x their fee capture. This distribution model essentially treats native tokens as marketing and customer acquisition expenses. We just talked about that with Compound. That's literally what they did. They came up with some comp tokens, gave it away just so that people can come on and borrow and lend. But the thing is, it's not sticky. Okay, so they go on to say DeFi 1.0 has been plagued by copycat protocols featuring zero utility and high emission governance tokens that inevitably get farmed to zero. So this chart below tracks the value of DeFi 1.0 tokens against Ethereum. And as you can see, you know, for all of you who aren't technical analysis experts, this is a downtrend, right? Just not good. And they go on to say that this occurred for several reasons. The tokens did not provide sufficient utility, and governance only tokens with zero value accrual got appropriately repriced to the value of governance over time, and extremely low barrier to earning DeFi tokens for mercenary liquidity providers. LPs could deposit tokens, earn yield, sell off tokens, and then move on once yields compress. This was seen time and time again on 95% of DeFi protocols. That's literally what we were just talking about. Now, so they're going to go on to talk about DeFi 3.0 here. Now, a lot of times it's not the first mover who wins. Look at all the social medias that was around before Instagram and Facebook. Like you had MySpace, Tumblr, Black Planet. I don't know if y'all ever heard about that, but it was so many social media platforms. So sometimes it's not all about being first. Sometimes there needs to be someone to go out there and do it first so that people can see it and learn from it and come out and actually make something better. And I think that's what Radiant's trying to do. Let's continue here. We will be outlining various strategies to solve some of Radiant's initial mistakes in version 1 while ushering in a new ecosystem that our community has colloquially, but hopefully I pronounced that right, labeled as DeFi 3.0. So the ecosystem is going to be focused on various mechanisms in place to prevent mercenary farming, which is sticky liquidity, use cases with real utility for the future and longevity of DeFi. They're talking about seamless cross-chain borrowing within minutes, true governance with fully implemented discourse discussion boards and snapshot voting, and then support for 20 plus new collateral options with extremely safe loan-to-value limits, generating more platform fees for the DAO. So right now, collateral, you can use Ethereum, Bitcoin, Tether, USDC, and DAI. They're trying to get more. So now they go on to talk about what didn't work with version 1 of the platform. So they say initial emissions were unsustainable and led to too much inflation. So while this sparked an early surge in the total value of deposits peaking at around 500 million, mercenary liquidity was not sticky and did not further the protocol's capabilities. This made them introduce solutions to reduce emissions. So they reduced them over time. And that's why in the beginning I was selling off some of the tokens just so that I can, lock in some profit. They had insufficient runway. The original tokenomics detail how lender and borrowing emissions would expire after 24 months, which is insufficient to achieve long-term cross-chain vision. Yeah, to be honest, I didn't even know this was a thing. This is new to me. Exit penalties were not optimally designed, so a user who exits on the final day of a vest shouldn't be penalized in the same way as someone who exits within the first minute of a vest. This system forces users into a suboptimal binary decision whether to exit or fully vest. Consequently, this led to a high exit rate in the early days and further highlighted the need for inert liquidity. So basically what they're saying here is you could deposit money onto the platform and then you get paid in Radiant tokens, right? But you couldn't just take those tokens and have them in your wallet. You had to vest them. And when you vested them, they had to stay there for 28 days if you wanted to get the full vested amount. And if you wanted to vest early, you took a 50% haircut, no matter if you vested after 1 minute of vesting or if you did it on the 27th day. Like if you had one more day to get the full amount, you took a 50% haircut. Next thing they didn't like about version 1, fixed unlock periods created unnecessary FUD. So grouping unlock events into universal weekly epochs creates weird game theory dynamics which aren't particularly helpful or useful. Basically what they're talking about here is when you vested or you locked, I think the epoch was like every Thursday at a certain time. So like if you started to vest on Monday, Tuesday, or Wednesday, you wouldn't be able to take it until 28 days on the next Thursday or something like that. I don't know the actual epoch time, but basically what they're saying is everyone knew the epoch time when things were going to get unlocked, and a lot of people were trying to sell ahead of it because they thought people were going to unvest and then sell, or once they had the opportunity to have their tokens unlocked, they were going to sell. Let's keep going. And lastly, mercenary capital is incentivized. This is not exclusive to Radiant, but there is a general trend in this DeFi towards mercenary capital, users who extract as much value from the protocol as possible before moving, and we already talked about that. So how is Radiant version 2 different? One of Radiant version 2's first priorities will be to move our current ERC20 Radiant token to the layer 0 omni-chain fungible token format. This migration will make cross-chain fee sharing much more seamless, enable quicker launches on additional chains, and permit native ownership of bridging contracts rather than relying on third-party bridges. So what it sounds like they're saying here is that they're going to change it from an ERC20 token into a Stargate omni-chain token, and now it's going to make it easier to deploy Radiant Capital on other chains because Stargate is already interoperable with other chains. That's hence the name layer 0. So you have layer 0, then you have layer 1s, the tech stack, and then you have layer 2s with roll-ups and all that stuff. So layer 0, which is like Polkadot and Cosmos is like really trying to spearhead, is the protocol that allows all of these layer 1s to talk to each other. And we were talking about in the beginning of the video how interoperability is extremely important. So they're going to move the token to an interoperable token, which I don't think is a bad idea. The next thing that's going to be different in version 2 is the treatment of exit penalties. All right. So in Radiant version 1, users must either vest their Radiant emissions for 28 days or incur a 50% haircut in claimable emissions in order to instantly receive their token. In version 2, the DAO will implement a linear scale that gives users who exit between 10 to 75% of all emissions depending on the remaining vesting time. Also, vesting time increased from 28 days to 90 days. So now they made the vesting time longer and they implemented a linear scale. So it's not going to be like, oh, I'm vesting for 27 days, but if I don't wait one more day on the 28th day, I can only take a 50% haircut. No, they're making it now. So basically, the longer you vest, the more you'll be able to take out. Hence the 10 to 75% sliding scale. I don't know when the 10% is going to kick in and when the 75% cutoff is going to be. That remains to be disclosed. And then they're making the vesting period 90 days instead of 28. If Radiant continues to ship new things and continues to innovate, people are going to want to hold the token. And the longer people vest, the less selling pressure there is on the market. So I think this is a good thing. I like this. Let's keep moving. Okay, the next thing that's going to be different in version 2 is treatment of expired locks. So expired locks in version 1 receive the same treatment as locked Radiant in that both receive protocol fees. So meaning if you lock your tokens, you're getting paid an APR, and then after the 28 days is over, you're still getting the APR until you withdraw. But in version 2, the community has voted to remove expired locks from the emissions pool. Users will now be able to enable an auto relock option in the UI, which will allow them to receive emissions as they normally would automatically. So basically you're not gonna just be able to lock it. And this part kind of sucks because I just took some profit on Radiant and I was making the APR, but I had to unlock it because you can't unlock like a certain portion. I wish you could, so I had to unlock all of it. But now once the unlock period is over, you're gonna have to relock those tokens. So if you want to keep getting the yield and start over versus just have it sitting there collecting APR and be able to withdraw whenever you want. It sucks, but it's good for the long-term potential of the project. I am biased because I do happen to be a mercenary revolutionary farmer, whatever. But it's better for the project. So I'll probably just adopt a strategy where I have some tokens in my wallet and then I have some that's being locked. So that way I can be getting a yield. And if the price does the 10, 20, 30, 40, 50x, I'll be able to also take some profit and not just have to sit there and wait for the unlock to happen and hope that the price is still up. Let's keep moving on. All right, the next thing that's going to be different in version 2 is changes to protocol fees. So in Radiant's initial design, protocol fees generated from borrowers were emitted equally between Radiant lockers and lenders. 50% went to lockers of single-sided Radiant, and 50% went to people who were depositing liquidity onto the platform. All right. Radiant version 2 aims to provide a stronger utility proposition for the liquidity providers. Liquidity providers are the people who pair Radiant with ETH on SushiSwap. Radiant v2 aims to provide a stronger utility proposition for liquidity providers by improving the ratio of protocol fee splits while concurrently reducing the dilutionary impact of vesting Radiant. That's a mouthful, but I'm going to break it down, so bear with me. Radiant DAO stakeholders voted on the following split for version 2. 60% of protocol fees will be allocated to lockers, and 25% will be allocated to the base fee for lenders, and then 15% is designated for the DAO controlled operating expenses wallet, of which the use will be governed by a future on-chain proposal. This aligns incentives to the DAO governance model while ensuring that the project remains independent of external funding sources such as grants and VC support. And last but not least, Radiant will continue to allow all users to borrow and lend cross-chain seamlessly. However, in order to be eligible for Radiant emissions, aka earn Radiant tokens, users will be required to maintain a minimum 5% threshold in dynamic liquidity relative to the total value of their deposit. And it says all these features have already been built. They're just currently undergoing testing. So this isn't live yet, just so you guys know. So before I break this all down, because they have a picture down here below, they're going to talk about why dynamic liquidity is better than sliced bread. The DLP system is built around two core concepts. One, users that provide value to the protocol unlock the ability to receive emissions in Radiant tokens, that is. And then users that simply deposit but don't add value to the protocol will have exposure to natural market rates, but won't be eligible for Radiant emissions. Okay? So for example, if one user deposits 1 million into the Radiant market but have $0 in DLP tokens locked, they would be eligible to receive a base deposit yield but would not be eligible for Radiant emissions. On the other hand, if user 2 puts in 1 million into Radiant and have $50,000 worth of Radiant BNB DLP locked, hopefully they have a Radiant ETH because I don't want to hold any BNB. This user would be eligible for Radiant emissions, assuming the minimum 5% threshold continues to be met. So basically, if you put $1 million onto the platform, you have to provide liquidity with at least 5% of what you're depositing in order to get Radiant emission. And whenever you drop below that 5%, then you will go back to just getting the base yield. Okay. So it says logic dictates that farmers will be attracted to the higher yield since only a few participants will initially qualify for the DLP boosted emissions threshold. Okay. So hypothetically, they say if only 5% of the $100 million in current deposits qualifies for the Radiant emissions, this would 20x current yields, thereby driving further demand for DLP until an equilibrium is reached. So they show a graph on how this proposed mechanism would function. Okay, so if you just lend and borrow, you'll get the base APY, right? But if you lend and borrow and you provide liquidity, you get that DLP boost. So you get the base APY plus Radiant boosted emissions, assuming it's that 5%, right? So if you claim your vested tokens before the 90 days, you'll receive the 10 to 75%. Remember we talked about that linear exit scale. So after you vest for 90 days, you can also lock. So if you zap into the locked DLP position, now you get to start earning the platform fees, and you have to USDC, you have the Tether, and then they're showing like Binance USDC or Binance USD because they're planning on launching on Binance next. I don't do any farming on Binance, so I'm hoping that I'll be able to still do this on Radiant and just do like ETH RDNT, but only time will tell. So now let's cover what will happen to the current single-sided staking mechanism. The DAO is transitioning the locking mechanism from single-sided Radiant to dynamic liquidity tokens, and we just talked about that. So this time already passed, but they say in order to ensure that there are no unlocks, that occur after the V2 migration, they'll disable all new locks of Radiant on Wednesday, January 18th. Therefore, during the final month leading into Radiant's launch for version 2, the only staking options available for liquid Radiant would be staking via the Radiant Wrapped ETH. So let's go to the Radiant website and look at some of this. So as you can see, I'm still in my short position, short in ETH and Bitcoin. I might double down on it given this recent pump, but that's neither here nor there. Let's go to the Manage Radiant tab, right? And I'm going to vest these and see if it gives me the 90-day vesting period. So yeah, the changes haven't been implemented yet because I just vested these and it's saying that the vesting period is going to be over on 2/22, which is 28 days from now, give or take. So you have to go on Sushi Swap and provide liquidity and Radiant Wrapped ETH. So it looks like they're going to be able to do that. And then you take your LP tokens here and stake it, and then you get a 60% APR, right? Looks like you'll earn in Radiant tokens. I don't know if you'll earn extra LP tokens as well, but you'll definitely get an APR in Radiant tokens. I'll give you guys an update as I do this because I am going to do this, but I just want to make sure everything transfers over seamlessly. That's another drawback. Like when doing huge updates like this, like they're switching their token, they're launching on a different chain, you know, that's a lot of vulnerabilities, a lot of bugs that can happen. You know, shit can get hacked. This is DeFi. And they did have 2 smart contract audits from Solidly and PeckShield, which is good. But there's a lot of companies or projects that's been hacked even though they had audits. So I'm just going to wait to see everything go smoothly. I already took in some profits and I still have a nice bag of it, but only time will tell. Okay, so now that we covered all that stuff, their upgrades and everything, let's get into the price prediction. So, you know, like I always say in my videos, I like to start from the monthly and go down. As you can see, you know, they've had this recent pump as their people are preparing for them to have this launch. Might be the buy the rumor, sell the news kind of event, which is why I took some profits. So I took some profits at 10 cents. And if we look here, you can see that momentum's starting to wind down. We saw a price go all the way up to 15 cents. I don't know if it's going to consolidate here. This hasn't been like a strong support area. Like, yeah, prices went there, but it hasn't like chilled there yet, but it is still relatively new, so it could. And then if we go to the day, we can see it. It kind of looks like trends, the momentum starting to fade even more, but we'll just have to wait to see if this consolidates. Like if we go back up, you know, I'll probably just keep taking profits. If we drop down, I will definitely buy some more. Let's just go down one more to the 4 hour. Yeah, it looks like for now that it's found support at this 10-cent range, but let's see how this upgrade goes and see if everything works seamlessly. So now let's get into the price prediction, and to do that, let's look at their competitors. So Radiant Capital's biggest competitors are Aave and Compound. Let's go over their biggest one first, which is Aave. So in order to do a price prediction, you know, they're competing for the same market, so we need to look at their potential of taking market share away from Aave and Compound and the like, and you know what that will look like for them in a bear and a bull market. So we're going to be looking at their market cap and their fully diluted valuation, but taking into account the fully diluted valuation. So let's just talk on this real quick. The market cap, in order to get the market cap, you just you multiply the circulating supply by the price and you get the market cap, but the market cap only takes into account the circulating supply. You want to take into account the max supply because that is like the token inflation that you have to account for. And then you want to look to see like, how are these tokens going to be unlocked? Is it VCs? Is it just unlocks that goes to the team? Whatever the case may be, you need to be aware of that. So for Aave, there isn't a big disparity between it. Most of the unlocks have already happened. You see a market cap of 1.2 billion and a fully diluted valuation of 1.3 billion, right? Fully diluted valuation is also what people use in TradFi, traditional finance. Next, let's look at Compound. So Compound has a $395 million market cap and a $576 million fully diluted valuation, okay? So that's Compound. And keep in mind, we're in a bear market right now, right? Price is $57. And if we look at Radiant, they have a $11.5 million market cap and a fully diluted valuation of $104 million that's going to get paid out to stakers over time, okay? There's no VCs or anything that's going to trigger any massive unlocks and selling pressure, which is good. So where do I see Radiant Capital going? Well, let's look at this. If we go here to Compound, then let's go max and let's hit market cap. At their peak, their market cap was around 4.3 billion in the bull market, right? And if we look at Aave, their peak market cap in the bull market was 8 billion, okay? And remember, even though Aave and Compound are multi-chain, their liquidity is fractured, meaning if you deposit on one chain, you can't borrow on the other one. You have to deposit on it and borrow on the other one. Like it works in silos, even though you can go on multiple ones. They can't the different chains can't talk to each other within the protocol. You know, it's hard to kind of just maneuver like that. Like you pretty much have to write up new code. However, and also with Aave's, they're aiming to launch portals with their V3, but they aren't live yet, and it'll be limited by Aave's structure because they have the same problem that Compound has. Like their chains can't talk to each other. You can't deposit on one chain and borrow on the other, right? Radiant is building from the ground up with cross-chain in mind from day one. So the winner of the omni-chain money market war, I definitely can see in a bull market. And again, remember, this next bull market, we're going to see way more institutions get in, way more banks. You know, regulation is clearing the path for that. So this it's gonna be a higher ceiling for sure. Okay, I can definitely see at minimum for a money market, an on-chain money market, at least a $5 to $10 billion market cap for the winner during the height of the bull market. From Radiant's current price, that's a 434 to 869x return. That's insane. That would bring the Radiant Capital token price from 10 cents to between $43 to $86. You only need like one of those trades per year to really just move the needle on your net worth. Okay, and that's why I feel comfortable buying this during the bear market. Like they launched in the bear market, the FDV is relatively small. I'm already playing with house money on this project. They're constantly shipping. The community is really responsive and interactive. Twitter followers are growing. Like they're checking all the boxes, okay, for the most part. And let's look at one more of their growth metrics that I just saw on their Twitter. This is from Arbitrum. This was from January 25th, so last week. So the most new users within 7 days. Radiant was number 2, right behind DopeX at 2,196 new users. Radiant Capital got 1,977 new users in 7 days. That's pretty good, especially during bear market times. Okay, so with that, I hope all of this made sense. You know, I always like to say, invest in what you understand. This value proposition makes total sense to me. Hopefully I was able to talk about it in a way that it makes sense to you. If not, ask me some questions in the description, or even better, apply in our link in our description to get into the Know It Owls Discord. We'll be launching in mid-February, where we talk about projects like Radiant Capital and other yield farming strategies and other projects that we feel can move the needle on your network, and you know, just to chat and become better people. So I'll wrap up this video here. Please consider subscribing, as you know, we're trying to get this message out to the world and grow this channel. And consider liking. It's the best way you can support the channel. Leave a comment on where you thought I was wrong, what project you want me to cover next. Any constructive criticism or feedback, I'm always open to it. So with that, I thank you so much for watching this video. I love every single one of you, and I'm about to go play basketball, and I will see you in the next video.